We are thrilled. I am thrilled. I don't know if you're thrilled, but you should be. We are going to have somebody who you don't see much outside of his channel. I'm not 100% sure what that is, but Dillon Loomis is going to be on my channel, and that's what counts. So, hello, Dillon. How are you doing?
I'm doing very well, Randy. Appreciate you having me. It's always good to have one of these rare occasions where I jump out here into social media land. So it's always nice to talk with other people in the space. But I'm doing well, digesting everything from earnings and yeah, just taking it in.
All right. Well, hey, listen, if you think it was really cool to have Dillon Loomis on today, would you hit the like button? That'll tell me that I should have him back and back and back, and well, at least as often as he's willing to come. Let's jump right into the big issue of the week. Everybody, I think you say in the green room, whatever it was that we were just in, you said that you're not shocked by anything anymore. I said I was a little shocked by quite the size of the takedown on the stock this week. You say you're not shocked. Tell me why.
Yeah, so honestly, I've been expecting this to some degree, maybe not from the auto gross margin X credit perspective, but if you watch any of my electrified videos for the last 3 or 6 months, I've been saying we should be expecting a slowdown in the auto industry. We should be expecting margin compression, even for Tesla. So again, none of that has been new. And the expectations for the day, I mean, sure, maybe Tesla missed on a few lines by a couple basis points here and there. But again, at the end of the day, I think for the most part, this was to be expected, at least to some degree. Okay. So with that said, there were a couple of surprises that I think we can get into later, specifically the, auto gross margins and how Tesla changed the reporting on that the day before. So we kind of should have seen that coming. But overall, again, just so everybody is aware, I approach this from a long-term investor standpoint, from a Tesla fan standpoint. I'm a much bigger fan of the tech and the company mission than I am quarterly results or even the stock price in the short term. And again, this is going to rub some people the wrong way, but I root for Tesla stock to go down right now. As an accumulator of Tesla shares, I am actually rooting for an earnings miss just because I have that much conviction in the long-term story with the Gen 3 and Cybertruck, Semi, Robotaxis, everything Tesla's been working on, Optimus. And, I just think we have to be patient and weather the storm. But yeah, I think this year is going to be a challenging one and the numbers could get worse into Q2. I'm not, I don't think that's out of the question by any stretch. So yeah, those are my initial thoughts.
So I did a video yesterday, I'm not sure when this is going to be out. It could have been yesterday, the day before, but I talked about that Tesla actually has a supply problem, that they have to sell between 500,000 and 900,000 more vehicles this year, almost all of those Model Ys, than they did last year. And that's a pretty significant number of vehicles when you consider that there's only a handful of auto cars out there that sell 500 to 900,000 per year total. And they've got to add that many, almost 100% Model Ys. So it's a significant get. It isn't a demand problem, as Elon keeps saying, but he didn't say it quite that way. He just says it's not a demand problem. We can sell lots of cars if we lower the price. But I thought contextualizing it in terms of they got to sell 500,000 more cars than last year kind of changes how you look at it. What do you think?
Yeah, no, I honestly, that's in line with one of what I thought was somewhat of a surprise when they were saying that both Berlin and Austin are still margin headwinds. I thought we had heard a few weeks, maybe even a few months back, that Berlin was already in profitable territory, meaning it would have been a margin tailwind, which again sounded odd given that it was early, but we know that they've kind of hit that volume production 5,000 a week level. So I didn't think it was out of the question, but based on the call last night, it seemed like those are both still margin headwinds. So that was kind of surprising for me. At least my expectations were off on that one. But yeah, in terms of the Model Y ramp, I think a big thing is the 4680 progress, and we did get some positive signs there. Yes, I think it's slower than Tesla had said it would be, and slower than I think a lot are hoping for, but I just think no one really understands the challenges of the dry battery electrode, and to have them have those lines up and running. They're on the 6th or 7th iteration on that specifically. They have them running continuously. They have a next generation cell that they're already working on that's easier to manufacture. They're going to be at like 70% less cost per gigawatt hour when that is ramped in Austin with the 4680s. So having that Model Y, the like the base entry level now with the structural pack 4680s in the configurator is obviously a very bullish sign for 4680 production. And Cybertruck seems to be online, which will use the 4680s. So yeah, from a Model Y standpoint, the best selling car in Q1 in Europe, full stop. That's a huge feat. And I think globally by the end of this year, yeah, that has a real chance to be in the best selling car in the world. So they need to sell a lot of units, but they're on track to do it so far.
It has to be the best selling car in the world. If you add 500,000 to last, even their minimum, which is 1.8 million, that's 500,000 more. So you add 500,000 to their numbers last year, it has to be the best selling car in the world, unless one of the BYD cars could possibly get to those levels. I don't think there's any BYD car that could get to that level in 2023. So
yeah, exactly, because they're relegated to the Chinese market. I know they expanded to Europe a little bit, but that's very early, very new. Those numbers are still minuscule relative to that market. So I think Tesla has an advantage there operating globally, especially as those factories ramp, and they're entering new markets seemingly every quarter. So yeah, but I hear you. I mean, BYD, they move volume for sure.
So
no disrespect there.
So I understand that apparently you, like Elon, do not have a crystal ball, and so
sadly,
and I don't either. I've been looking for one, but I just can't find the right model, the right make that gives me consistent results.
Keep me posted.
So without knowing what the Fed's going to do, without knowing whether the overall U.S. economy is going to go into a soft or a hard landing, or when it's going to go into a soft or hard landing, do you have a sense of what you think? Elon suggested maybe some tough times for the next 12 months, and then maybe brighter times starting next spring. Does that comport with anything you're seeing in the macro?
So it does, actually. And quite frankly, knowing what the narrative has been, I've kind of just chalked up the next year or so to expect some, again, Tesla share price depression, which again, I'm here for all of it. One thing I definitely am watching is the unemployment rate, because the whole recession versus non-debate, I understand why it gets so contentious, because there's a lot of nuance that is lost in that conversation. How are we defining a recession? Are we going by the MBER? Everyone has a different definition. Is it the stock price? Is it the S&P? So from that standpoint, for me at least, I don't think the official recession will be declared until we see unemployment tick up, because it's still at historic lows. So the thought is, all right, well, we can't be in a recession until something happens with employment, right? So, but again, I don't know that we need to necessarily get into the weeds of that. But again, my expectation for, the next year has just been to not expect any breakouts in the stock market. Same thing with Tesla stock. But again, it's irrational and there will be runs along the way. But yeah, until we see at least some certainty around inflation and interest rates, we have an idea of what's expected, and you can look into the bond market to see what they're forecasting, and they're definitely expecting, inflation to come down and interest rates to come down because of, I think, an implied recession here looming. But yeah, to how long, to what degree, it's anybody's guess. But I'm kind of with Elon, and that time frame makes sense to me.
So, typically there's this old saw that, spring of an election year, the market will go up because the incumbent president and his staff will want to have good times rolling by the time there's a vote in November. Do you think there's enough brain power in the current administration to even make that call?
Oh, Randy really put me on the hot spot with that one, man. So yeah, I mean, to anybody watching, I don't really do politics. I don't get into it too much, and I don't want to offend anybody, because I know it's a hot place to have an opinion. Look, I think there are definitely some, there are things that can be done, but the question always goes back to the long-term impact, and again, to what degree I know the Fed's supposed to be independent of the government, but at the end of the day, can we really trust anything that the government and or the Fed is telling us? And So I don't know. Yeah, again, I'm not going to get into that one too deep.
All right. So you said there were surprises. Have you already gone through those surprises? Because you did mention one surprise, or were there more surprises to you in the earnings?
So I think, if I'm being honest, the auto gross margin ex credit number, I was expecting Tesla to hold a little bit higher. Not that I'm disappointed with it by any stretch. It's just, if I was forecasting personally, it probably would have been a touch higher. Nothing out of the ordinary, but I thought, there's a chance of holding above 21, 22 when it comes to that X credit number. But again, there are just so many factors at play. And again, some that are out of Tesla's control, specifically certain commodity costs. And they're working on a timeline in the future to try to project where everything is going. And they have more real-time data than anybody in the world. So that's nice and that helps. But at the end of the day, again, not to lose sight on these short-term metrics, because again, the bigger picture is such a beautiful, optimistic thing. And I don't want that to be lost on anybody. And I touched on it in yesterday's video, but Tesla having a fleet and getting more people into Tesla vehicles, into the Tesla ecosystem. So there's more supercharging, there's more, it's just, they're going to be plugged into the network. And of course, in the future, whether you believe in autonomy or not, I think we can at least agree it's progressing. Over time, it's getting better. And maybe It's not worth $15,000 yet, but there are certain, we're on a path here. So I just happen to agree with the strategy. I think Tesla's operating margin and all of those numbers are still leading the industry, maybe not like the best, but they're right up there. And that's something I plan to touch on in my video today. So again, I just think it all boils down to where your expectations were going into the call. But yeah, I mean, I think those are the two that I was, planning to look into for sure.
Yeah. So I think long-term, and as you point out, the long term is what matters. So in the long term, we can be pretty confident that Tesla is going to continue to have the lowest cost of goods of anybody out there. I mean, everything that we see in terms of their manufacturing capability, all the new ideas that they're putting into the manufacturing aspects, their ability to buy much larger quantities of things, moving further along on the curve on the battery side, their relationship with CATL, et cetera, should mean that they're going to be the lowest cost producer out there. Whether they can maintain 25% margins every year, I mean, that's kind of, again, what my point was. This year, they only have to sell 500 to 900,000 more Model Ys than they did last year, which to me is a huge mountain that I think they'll address and do. And it may take some, like you say, margin compression to get there. But in a couple of years, they're going to be adding 2 million vehicles a year to the previous year. And then a couple of years after that, they're going to be adding 5 million vehicles to the previous year. So you're looking at a situation where they're going to be adding in 1 year enough total metal to outstrip all of the car companies in history, except for a handful. And they're going to be adding that in a single year. So over time, I think we need to switch the thinking to how do you move the additional supply, as opposed to do people love Tesla enough to want one? I think that there's a big bunch of people out there that understand that they would rather be in a Tesla for a whole bunch of reasons, but you got to be able to provide them the compelling price, as Elon says.
Right. Yeah, I think it's pretty simple. They're just going to continually ramp production, enter new markets, and then set the price at whatever it needs to be to clear that inventory. And I do think because their demand is strong, the brand is strong, it's not going to get out of control. And I think some people are getting a little worried of the comments Elon made that they're able to sell cars basically at cost, and kind of taking that to assume it's like going to happen. I don't think that's the case. I just think hypothetically he's willing and they're able to do that, to get away with it, because they have that switch of potentially autonomy, FSD in the future that they might be able to turn on. And I just happen to believe it's true that nobody else has that switch, regardless of what they say. And that's one place I definitely disagree with Gary Black. He thinks everybody's just going to have autonomy. I could not disagree with that more, because again, they're approaching it from a very different strategy, and It's the localized mapping. How can they scale it? Will those costs come down? Because most of the competitors have more cameras, they have LiDAR, they're using these things that are not going to allow them to be cost competitive with Tesla, specifically in the autonomy space. So, but one thing I did want to mention before I forget, and another, not necessarily surprise, but is Tesla Energy. I still think so many people are asleep at the wheel when it comes to the Megapack specifically. So deployments were huge. They were almost 4 gigawatt hours in the quarter. One thing I kind of was hoping that the energy gross margin would have been a little bit higher, given that Lathrop is now ramping, but it was actually around 12% in Q4 and it was 11% in Q1. So I thought that was interesting. I didn't know if the price of the Megapack had come down or they had some extra, logistical shipping challenges throughout the quarter. I would have liked some more color on that. But I was pleased that we got the Megapack gross margin expectations, mid 20s. But again, we're still left with some questions. Is that with any Inflation Reduction Act producer side credits, or is that 25% just from the Megapack hardware? Does that include any software revenue that Tesla's undoubtedly getting from the Megapack? So still a lot of questions out there, but we have a lot more color than we did. And I think that was very important because there were definitely some people in the community expecting over 50% Megapack margins. And, not that that's impossible or anything like that. I just think, again, for the near term, that's not accurate, right?
Well, there are a few other issues there. So number one, that energy section includes solar, and solar can still be a drag. That could still be I'm sure it's very likely still taking a loss. Number two, Lathrop is still ramping. So there could be margin headwinds there from the ramp. So they may not be anywhere close to getting to their 25% just because the CapEx is still being worked out. They also said they're putting more CapEx into it in the third quarter so that they can finish the ramp. So we know there's additional headwinds coming on that. And then some people are saying, I'm pretty sure that we have good reporting that they were still making some product up in Reno, and that product was probably being sold at the old price. And so that was probably a big drag. But according to the sources I'm seeing, that Reno production has stopped now, and those orders are now complete. So that part of it should be out of it. So I've been saying that my thinking was I would love to see the revenue showing up, and I'd love to see the profit, some additional profits showing up. I'd like to see it separated so we can see exactly what's happening with Megapack. And then, but I was very surprised by the statement that we're aiming for the 25%. All the reporting seems to suggest that there's at least a 40% margin, based on just doing the math, just looking at stuff costs. Yeah. So anyway, that's kind of where I see energy going. But to your point, I mean, holy mackerel, adding Shanghai, getting fully ramped. Nobody's paying attention. The street certainly isn't. I think it'll be at least 2 quarters before the street really says, wait a minute, look.
Right. And I think Shanghai, that'll be a big deal because most of the battery energy storage deployments globally are in China right now. And that's actually one area that I'm looking into right now is what, if any, type of incentives does the Chinese government have for battery energy storage systems, similar to the Inflation Reduction Act. So yeah, it's definitely going to take some time and it's not going to be the most interesting topic. But again, from a Tesla investor standpoint, I just think when you think about the 4680s in the future, as that production ramps, those potentially making their way into a Megapack where they could get the full $45 per kilowatt hour tax credit. Again, on the producer side for having the cells that are made in North America, as well as the $10 per kilowatt hour for the assembly, having that full credit, when you do the math, it starts to, it's in the billions, right? With a B. Yes. So again, just have to be patient and we'll see if Tesla decides to do that. But we're still waiting to hear on that potential Tesla factory with CATL in the States. So we'll see.
Do you have any thoughts with regard to quarter two? I was going to do my quarter two analysis this weekend. I have no idea right now what it's going to look like. Have you thought about quarter two at all?
So when it comes to quarter two, one thing to keep an eye on will be the free cash flow number. So that dropped to around 400 million in quarter one, which was down from, I think, around 2 billion in quarter one last year. So of course, a big driver of that increased inventory, that's going to hurt your free cash flow. So this unwinding the wave that Tesla's been doing, trying to smooth out the end of quarter delivery rush, that's going to have a negative impact on free cash flow, as will, of course, price cuts and cost headwinds, things of that nature. But given that, I think if that flips negative, that's definitely going to be a Wall Street no-no, because again, Tesla is valued as a margin growth company. So that's kind of what my video was meant to get at yesterday, is that we kind of have to rethink a little. It's not that Elon and Tesla don't care about profits. It's not that that's not at all the case. It's just that on the totem pole of priority, their priority is now max volume growth. And that's above the keeping margins artificially high. Yeah. So I guess you can debate that point. It's just, I happen to agree with that thesis, and I'm glad Tesla is doing it, because it's pretty obvious, like Renault and some of these other companies, if their volumes aren't growing, well, then they basically don't have a shot at being cost competitive for all the things you mentioned, the supply chain being built out and getting good deals, negotiating leverage, and, utilization factors of factories and all of those things. So yeah, quarter two, again, I have my expectations pretty low. I think we could see further gross margin compression. I think free cash flow will be one to watch. But again, with Tesla having over $22 billion in cash, even if they go negative free cash flow a quarter or two, in the grand scheme of things, I personally don't really care. There will be most likely a good explanation for it, but definitely something to watch, especially from a Wall Street short-term stock price perspective.
Yeah. So another confusing point for me, and you're actually a professional in the area of watching stocks, or used to be at least.
Yeah, so, used to be keyword.
But one of the things, it seems to me that a smart analyst wants a growth company to be investing in the future. And on the one side, that could be investing in the future in terms of CapEx spend and putting money into R&D and this kind of thing. And I've seen plenty of analysts who have complained about companies like Apple or whatever not spending enough on R&D or enough on CapEx, but buying another company, putting money into new equipment, or putting money into R&D. These are all things that typically, at least long-term thinkers, want companies to do, especially if they're growth companies. Well, wouldn't one aspect of that also be growing overall market share by massive leaps and bounds, and so if you end up spending a couple of $1 billion in a quarter on your overall R&D and CapEx, but maybe you spend another $1 billion on less margins in order to increase market share, which is going to just have a continuing effect years into the future.
Yeah, it's a great point. I just think it boils down to people are using the margin numbers to then extrapolate the future. And when it comes to Tesla's valuation, that's where the disconnect is. So, they'll take whatever number metric you want to use and then go from there. But again, we're coming from a really high base of Tesla performance in Q1 of last year. So even before quarter one happened, we should have known that's a pretty high bar to compete with, given everything that's changed. So, but let's look at the bright side. Now, 2024 quarter one, we're going to have a much lower base. So when we're looking at the auto gross margin X credit or free cash flow or any of these metrics that are now lower, well, the bar's low. So come next year, your year-over-year numbers might look incredibly good. So again, it's all cyclical. And I just kind of take a long-term view at the end of the day.
All right, Dillon. Well, thank you for your analysis of the quarter. I did listen to your reporting on that I think that was on Thursday. And I thought it was spot on, which then thank you for giving us more color on your analysis. And
my pleasure.
And we will do this again. In fact, I think you'll probably be on my Monday morning show. So everybody watch for that. And if you haven't already hit the subscribe button and the notify button, you should do that. And then after you do that, you should go on Dillon Loomis's YouTube channel and you should follow him on YouTube and sign up for his Patreon and mine too. And anything else that they should do, Dillon, to support your channel and your activities?
Yeah, I think you covered it all. I mean, I'm on Twitter trying to use it a little bit more nowadays, but you nailed it.
You're not that active on Twitter.
No, I'll be honest. It's not a platform I have loved as of late. I'll go a couple of days where I really enjoy it, and then it's like I need to check out and get out of here for a little bit and be in the real world with my wife and go be outside and golf. And I have a lot of other things I like outside of Tesla. So, but no, yeah, you hit it all.
Okay. Hey, great. All right, Dillon. Thank you for being on, and
my pleasure.
It's been great talking to you.
Thanks for having me, Randy. Appreciate it.
Click the link below to get your paperback, Kindle, or audiobook now.